You've got $100,000 sitting in your account. What you do with it next could be the difference between retiring at 55 or grinding it out until you're 70. Do you put it into the stock market and let compound interest do the heavy lifting? Or do you use it as a deposit to leverage into property and let other people's money build your wealth? This is the great Australian debate, and today we're settling it with real numbers. $100,000 in stocks versus $100,000 in real estate. Which one actually wins? Let's start with stocks because most people underestimate how powerful this option really is. If you drop $100,000 into an ASX 200 index fund today, history suggests you'd earn roughly 9 to 10% per year when you include dividends. But here's the part that makes the Australian share market special: franking credits. Because Australian companies have already paid tax on their profits, you get a credit that boosts your after-tax return. The average dividend yield on the ASX 200 right now sits around 3.3%, and a big portion of those dividends come fully franked. When you factor that in, your effective return gets even juicier. So let's run the numbers. $100,000 invested in a diversified ASX index fund, compounding at 9% per year for 10 years, grows to roughly $236,000. Stretch that out to 20 years, and you're sitting on about $560,000. Here's the beautiful part. You didn't need a bank to lend you anything. No mortgage applications, no landlord insurance, and no tenants calling you at midnight because the hot water system blew up. You just bought the fund and let compound interest do the work. There's another advantage people rarely talk about: liquidity and flexibility. With stocks, you can start small and add consistently. You could drip feed an extra $500 a month into that same index fund. Do that for 20 years at 9%, and you're not looking at $560,000 anymore. You're looking at well over $900,000. That kind of dollar-cost averaging smooths out the bumps, takes emotion out of the equation, and turns your wealth building into a boring, beautiful machine that runs on autopilot. But here's where things get really interesting, because property investors have an unfair advantage that stock investors simply don't have easy access to: leverage. This is where the debate flips. With $100,000, you don't buy a $100,000 property. You use it as a deposit and buy something worth $500,000 or even $600,000. The bank lends you the rest, so your $100,000 is now controlling a $500,000 asset. Australian property has historically grown at about 6 to 7% per year on average. That sounds lower than stocks, right? But hold on, that 6% isn't growing on your $100,000. It's growing on the full $500,000. A 6% increase in year one adds $30,000 to your net worth, not $6,000. That is a 30% return on your actual cash invested. To put this another way, with the national median dwelling value sitting high and gross rental yields between 3 and 4%, a $500,000 property investment in a solid growth corridor could bring in roughly $20,000 a year in rent. Now, once you subtract mortgage payments, insurance, council rates, and maintenance, your cash flow might be slightly negative. This is negative gearing. In Australia, you can currently claim those losses against your taxable income. However, it's worth watching this space because policy changes regarding negative gearing and capital gains tax discounts are frequently debated in the lead-up to federal budgets. If tax advantages shrink, the math changes, but the power of leverage remains. Let's crunch the property numbers over time. A $500,000 property growing at 6% annually is worth roughly $895,000 after 10 years. Subtract your remaining loan balance, and you're looking at a net equity position far larger than what stocks would have delivered in the same time frame. Over 20 years, that same property could be worth over $1.6 million. If you've been collecting rent the entire time, even after expenses, you've built a seriously powerful wealth engine. However, many people overlook the entry costs. When you buy a $500,000 property, you don't just need the deposit. You need stamp duty, which can run between $15,000 and $22,000 depending on your state. Then there's conveyancing, inspections, and potentially lender's mortgage insurance if your deposit is under 20%. All up, those costs can eat $25,000 of your $100,000 before you even own the keys. With stocks, your entry cost is basically zero. Most platforms charge tiny brokerage fees. When comparing like for like, you must account for the fact that property chews through a chunk of your capital just to get started. Picking a winner and moving on isn't how real wealth works. Stocks and property have fundamentally different strengths. Stocks give you liquidity. You can sell $5,000 worth of shares on a Tuesday and have the cash by Thursday. Property gives you forced savings through your mortgage and leveraged growth that is almost impossible to replicate with shares. Stocks give you instant diversification. One ASX 200 fund means you own a slice of Australia's biggest banks, miners, and retailers. Property concentrates your risk in one asset in one location, but it gives you control. You can renovate, you can increase the rent, you can add a granny loft, you can force the value up. With an index fund, you're a passenger, a well-rewarded passenger, but a passenger nonetheless. The current environment also plays a role. With the RBA cash rate sitting higher than in previous years, borrowing costs are significant. If you're buying property with a mortgage, you're paying serious interest. Stocks don't care what the interest rate is. Your $100,000 just keeps compounding. On the flip side, rising rates can suppress property prices, meaning if you have the cash and the courage, you might be buying real estate at a relative discount before the next growth cycle begins. There's also a psychological element. Most people who invest in properties stick with it because the mortgage forces them to. You can't panic sell a house at 2 a.m. because you saw a bad headline. With stocks, the temptation to sell during a market dip is always there. Behavioral finance tells us that the average investor underperforms the market not because the investments are bad, but because human emotion gets in the way. Sometimes the best investment isn't the one with the highest theoretical return, it's the one you'll actually hold on to. So, what is the real answer to the $100,000 question? If you want simplicity, low maintenance, and solid long-term compounding, stocks are incredibly hard to beat. Drop the money into a diversified fund, reinvest the dividends, enjoy the franking credits, and let time work its magic. If you want to accelerate your wealth using leverage and you're prepared to handle the complexity, expenses, and physical management of an asset, property can deliver returns that stocks mathematically cannot match on the same starting capital. The real winners in the Australian market often do both. They build a share portfolio for liquidity and compounding, and they use leverage to grow a property portfolio alongside it. That is how generational wealth is actually built in this country. It's not about which one is better, it's about which one fits your lifestyle and your ability to stay the course. Whatever you choose, the most important step is moving that $100,000 out of a savings account and into an asset that grows.